There's never been a time in my life when I know what markets are going to do over a long period of time. They're going to go up. But in terms...
What to do when the market goes up? Investment opportunities are everywhere. You just need to find the one that is perfect for you, that suits your long-term or short-term needs. Over many years of its existence, people have finally mastered the art of speculating and understanding the stock market masterfully. Understanding the market trends could be very important, especially if you are new investors. If you are planning to invest hard-earned money, you should be well versed about the commodity and you are buying into. You might sit and hear tons of podcasts about the market and whatnot, but one thing that you should pay attention to is the various terms they use. The most commonly used phrase in all of the investment talks is unarguably the phrase, "the market is up" and "the market is down." What exactly do these phrases mean? And as an investor, what you should do during such moments? Let's tune into today's video and find out.
To thank you for watching this video, we're offering you an absolutely free training webinar. Do you want to learn the secret of improving all aspects of your life and unlocking what you're really capable of? The legendary Bob Proctor spent over 57 years learning this one thing and is hosting a free webinar where he reveals what he's learned and what actually works. He'll teach you the law of compensation, a secret only the mega wealthy know of but not taught in our educational system, and the impression of increase, the law of laws that will increase areas in all aspects of your life, whether it be in health, relationships, or wealth. Right now, the first 200 people to use the link below will get access to this free webinar. Now, let's get back to the video.
Understanding the term market up and down. Market forces influence stock values on a daily basis. This means that stock prices fluctuate due to supply and demand. When there are more people who want to buy a stock than there are people who want to sell it, the price rises. It's simple to understand supply and demand. What more difficult to understand is what makes individuals like one stock and dislike another. It all boils down to determining what news is good for a corporation and what news is bad. There are numerous solutions to this problem, and almost every investor you speak with will have their own thoughts and techniques. However, the main premise is that a stock price fluctuation reflects what investors believe a firm is worth. Don't mistake a company's worth for its stock price. A company's market capitalization is calculated by multiplying the stock price by the number of outstanding shares. A firm that trades at $100 per share and has 1 million outstanding shares has a lower value than one that trades at $50 per share and has 5 million outstanding, which means, well, let's take a break from all that math. So, what truly influences the value of a company? Earnings are a firm's profit, and no company can thrive without them in the long run. When you think about it, it makes logic. A corporation will not be able to stay in business if they never makes money. The earning of public companies must be reported 4 times a year. Once every quarter. During these periods, referred to as earning seasons, Wall Street pays close attention. Of course, earnings aren't the only factor that might influence stock values. If this were the case, the rules would be a lot simpler. During the dot-com bubble, for example, dozens of internet companies grew to billion-dollar market capitalizations without ever producing a single profit. As all we know, these valuations did not hold, and the value of almost all internet companies plummeted to a fraction of their previous high. Still, the fact that the price moves so much shows that the stock values are influenced by factors other than current earnings. So what causes stock price to fluctuate? The best response is that no one knows for sure. Some people feel it is impossible to forecast how stock price will change, while others say that by drawing charts and studying past price movements, you can figure out when to purchase and sell. The only thing we can be certain of is that equities are incredibly volatile and can change in price very quickly. What should be your game plan when the market shows such erratic changes? Finally, how optimistic investors are about a stock's prospect determines its demand. In the short term, strong business development such as quarterly earnings report that exceeds forecasts, analyst upgrades, and other positive business development may prompt investors to pay a higher price for stock. Disappointing earning reports, analyst downgrades, and a bad company development, on the other hand, might cause investors to lose interest, resulting in fewer demands and compelling sellers to accept lower pricing. Now that we completely understand what makes the market go up, let us understand what our plan of action should be.
To thank you for watching this video, we're offering you an absolutely free training webinar. Have you ever wondered how to end procrastination and self-sabotage so you can unleash your full potential to live the life you deserve? #1 best-selling author and high-performance coach Peter Sage is hosting a free webinar where he'll teach you how to increase your wealth with less time and struggle, and also how to hyper-boost your growth and success so you can finally break out of any rut you find yourself in. Right now, Peter and his team are offering a free $100 gift to anyone who doesn't find his webinar as the best use of their time within the last 5 years. Now, let's get back to the video.
If you invested well, your portfolio would have risen in tandem with the market. As a result, there is a reason to rejoice. All your hard work in studying, selecting companies, and investing is now bearing rewards. In other words, this is a moment that you may have been anticipating for a long time, and it is now has arrived. As a result, enjoy. When the market rises, though, there may be a few behavioral concerns that you observe in your day-to-day existence. It's critical to comprehend them because this shift could jeopardize your financial strategy. Overconfidence is an obvious behavioral issue when your portfolio is high and everything goes well. You have the impressions that you're terrific at such occasions because your strategies are successful. You have the perfected art of investing. This, however, may not always be the case. Your stock may increase up in price in tandem with the market rather than become its fundamentals. A key lesson to take away from this is not to become overconfident when your stock is rising in a bull market. When the market is high, it is very usual for investors to lose sight of their investment decisions. Perhaps you begin investing with the goal of creating a diverse portfolio with equal investment in several areas. However, if one of your stocks is performing very well, you may be willing to sell all of your other holdings and put your money into that one. Or perhaps you're considering switching from a diverse portfolio to a strategy that focuses just on mid-cap stocks, which are currently outperforming the market. Overall, it's tough to stick to a disciplined investment strategy when the market is so volatile. When the market is at an all-time high, it's the greatest time to sell your fundamentally weak but high-performing equities and take profits. Some companies in your portfolio may be performing well in terms of returns, but they may not be fundamentally sound and so do not deserve to be kept in your long-term portfolio. These businesses may not have competitive advantage or an edge that will allow them to continue to perform long after the bull market has ended. When the stock market rises, this is a golden guideline to follow. As previously stated, when the market is high, you may notice a variety of behavioral disorder in your day-to-day existence. You will begin to feel wealthy and you may desire to purchase your favorite automobile. Alternatively, you may intend to increase your market investments in order to reap further gains. However, keeping to your initial plan, which you begin investing in, is the best strategy here. Allow your investments to run if you're putting money into a retirement fund. Furthermore, invest in the market on a regular basis with the money you set aside. If your goals have not been met, don't sell your stocks only to keep the money in your bank account. When the market rises, you may have made some good money. However, it has the potential to provide far greater benefits. Ignore short-term market gains and concentrate on your long-term goal. When the market rises, rebalancing your portfolio is also a useful approach to employ. As an example, suppose you plan to invest 70% in stocks and 30% in debt funds. When the market is strong, these allocations can shift to 85% equity and 15% debt funds. You should now rebalance your portfolio to the original 70-30 ratio. When the stock market rises, it is a reason to rejoice. However, you might expect some typical behavioral changes throughout these times. When your portfolio is large, you may feel a little wealthier. However, keep in mind that these are unrealized earnings, so you might not be as wealthy as you believe. The money is only on paper and hasn't been credited to your account. Finally, disregard the highs and adhere to your long-term investment strategy. Wow, that was a lot of advice for one day, don't you think? However, we are always open to more suggestions and investment advice from personal experiences that could help many people out there. So, make sure you mention them in the comment section below. Hit that like button and support us and our content. There are many people out there in your friend circle who could definitely use some investment advice. Help them by sharing this video with them and help them understand the plethora of investment opportunities out there. Finally, subscribe to our channel for more such awesome content. And before we end today's video, we would like to say, please be careful while investing. Even the most calibrated decisions could prove to go the other way. So be cautious and happy investing. We will see you next time.